With an ongoing trade war and a looming recession, some Canadian industrial sector stocks are ready, they're ready to defy the economy. Hold on to your seatbelts, folks. This is going to be a good one. Canada's industrial sector stands as a cornerstone of the nation's economy, renowned for its stability and essential contributions to infrastructure and economic growth. The sector is not immune to external pressures, like those from those escalating trade tensions initiated by Trump's tariffs, and of course, the growing threat of a recession. Industrial stocks often bear the brunt of tariffs, supply chain disruptions, higher production costs, and decreased consumer demand during downturns, placing significant strain on their performance. However, within this diverse sector, some industries are particularly robust, demonstrating remarkable resilience even amid economic uncertainty. Waste management companies, for example, provide essential services that remain in constant demand, irrespective of market conditions. Their business model ensures stable cash flows, defensive operations, and minimal exposure to tariff impacts, making them, of course, excellent defensive plays for investors during volatile economic periods. Similarly, Canada's aerospace industry demonstrates considerable resilience due to their higher specialized and global diversified nature. Companies within this sector often benefit from long term contracts, international partnerships, and robust demand for essential aerospace and defense products. These attributes enable aerospace firms to maintain steady revenue streams and to mitigate the effects of tariffs and economic slowdowns quite effectively. A sub to the channel is your long-term contract for future content. Today, we will be looking at 5 Canadian industrial stocks strategically positioned to navigate the current trade climate and those economic challenges that are coming with it. We'll answer why these companies could be strong defensive additions to your investment portfolio, helping you to protect and potentially grow your wealth, even in these turbulent times. In qualifying today's list, I needed to find companies with a strong track record of growth. Thus, they needed to be in the positive in all of the time frames that we use. I also wanted stocks with a minimum share price of $5. You guys know why, just to keep the penny stocks out of play. Anyway, without any further ado, let's do this. Kicking off our list at number 5, we have Waste Connections Incorporated with a ticker of WCN. They are one of the largest solid waste services companies in North America. They provide non-hazardous waste collection, transfer disposal, and recycling services, primarily in secondary markets across, both the US and Canada. At the time of recording, their price was coming in at $273.36. They have a market cap of $70.68 billion, and their beta pretty stable, 0.67. Their earnings per share, 3.33, and they have a price to earnings ratio of 82.09. Now, this is a sector that is growing, and that price to earnings ratio is definitely reflecting that. Their return on equity, 7.93%, and that return on assets, 4.06%. Their debt to equity ratio coming in at 106.97%. Switching to their dividend, they have a yield of 0.659%. It's a quarterly dividend of 31.5 cents USD per share. Payout ratio on that, 48.95%. On their returns, on their 3-year return on investment, that's coming in at 53.86%. Add in the dividends, total return 56.23%. On their 1-year return on investment, 19.82%. Factoring in the dividends, total return 20.55%. And their 3-year annualized, that is coming in at 16.03%. Waste Connections is in a recession-resilient industry due to their essential nature. They are known for their consistent cash flow, dividend growth, and smart acquisitions, making them it does make them a pretty solid pick for long-term conservative growth portfolios. Coming in at number 4, we have Dexterra Group with a ticker of DXT. They provide a range of support services, including facilities management, operations, and maintenance, remote workforce accommodations, modular building manufacturing, and environmental services. At the time of recording, their price was coming in at $7.96, and they have a market cap of 497.70 million. Their beta, pretty average, 1.04. Earnings per share, 0.58. That price to earnings ratio coming in at 13.72. Their return on equity, 13.27%, and that return on assets, 7.41%. Their debt to equity ratio, that's coming in at 30.52%. Looking at their dividend, they have a yield of 4.397%. It's a quarterly dividend, 8.7 cents per share. Payout ratio on that, 60.34%. Switching to their returns. On their 3-year return on investment, that's coming in at 8.30%. Factor in the dividends, total return, 22.50%. On their 1 year, that return on investment, 32.67%. Adding in dividends, we get a total return, 38.47%. Their 3-year annualized, that's coming in at 7%. With recurring contracts and essential service delivery in critical infrastructure and resource-heavy areas, Dexterra, well, they offer a stable revenue base and attractive yield potential. The company also has a strong presence in Canada's remote workforce housing, which is vital for industries like mining and oil. Okay, coming in at number 3, we have Element Fleet Management Corporation with a ticker of EFN. They are the largest pure-play automotive fleet management company in the world. They provide financing, vehicle acquisition, maintenance, fuel management, accident recovery, and remarketing services to corporate and government clients across North America, Australia, and New Zealand. At the time of recording, their price is coming in at $30.09, and they have a market cap of $12.11 billion. Their beta, pretty stable, 0.61. Earnings per share, 1.33. That price to earnings ratio, 22.62, and they have a return on equity of 13.54%. That return on assets, 3.08%, and their debt to equity ratio, oh, it's a little high, 309.12%. Looking at their dividend, they have a yield of 1.728%. It's a quarterly dividend of 0.13. Payout ratio on that, 37.45%. Looking at their returns, their 3-year return on investment, 163.49%. Add in those dividends, total return, 174.82%. Holy banana bread, that's pretty good. Looking at their 1-year return on investment, that comes in at 38.86%. Adding in the dividends, total return, 41.16%. And their 3-year annualized, 40.07%. As fleets continue to grow in size and complexity, outsourcing to a specialist like Element can reduce costs and improve efficiency for clients. This creates a high recurring revenue model that continues to grow its base with large long-term contracts. In our almost top spot at number 2, we have GFL Environmental Incorporated with a ticker of GFL. They are one of North America's largest environmental services companies, offering solid waste management, liquid waste services, and soil remediation. They serve residential, commercial, and industrial customers in both Canada as well as the United States. At the time of recording, their price was coming in at $67.11, and they have a market cap of $24.81 billion. That beta, pretty average, 1.08. Their earnings per share, negative 2.11. I'm going to point out right here that I normally would eliminate a company for having a negative cash flow. However, in the case of GFL, this negative is due to their rapid expansion, as they've been very aggressive in acquiring other waste management businesses across North America. Also, GFL regularly reports amortization of intangible assets and stock-based compensation, both of which are non-cash charges. This does have the effect of lowering their EPS, while not really impacting their cash flow. And in fact, both their free cash flow and operating cash flows are well in the positive. Okay, their price to earnings ratio, that's negative as well. Negative 30.3. Some of the math, of course, is definitely off because of that negative earnings. Just like their return on equity, negative 10.10. Return on assets, though, it is in the positive 1.57%. Their debt to equity ratio, 146.07%. Looking at their dividend, they have a yield of 0.118%. It's a quarterly dividend of 1.5 cents USD per share. Payout ratio on that, 53.10%. Switching to returns, their 3-year return on investment, that's coming in at 73.32%. Factor in the dividends, total return, 73.86%. On their 1 year, that return on investment, 46.27%. Adding in the dividends, total return, 46.44%. 3-year annualized, 20.25%. GFL operates in an essential and recession-resilient industry. Their aggressive growth through acquisitions and expansion into U.S. markets has made them a formidable competitor to giants like Waste Management. With recurring revenue and a green economy focus, they're a long-term sustainability play. Okay, in our top spot at number 1, we have Magellan Aerospace Corporation with a ticker of MAL. They design, engineer, and manufacture aerospace systems and, components primarily for defense and commercial aircraft. Their specialties include castings, precision machining, engine components, space systems, and advanced composites. At the time of recording, their price was coming in at $12.83, and they have a market cap of $733.09 million. Their beta is 0.41, so they are more than half as volatile as the market average. Their earnings per share coming in at 0.62, and they have a price to earnings ratio of 20.69. That return on equity of 4.61%. Return on assets, 2.92%. Their debt to equity ratio, nice low number, I love it, 10.77%. Looking at their dividend, they have a yield of 0.779%. It's a quarterly dividend of 2.5 cents per share. Payout ratio on that, 16.13%. On their 3-year return on investment, that comes in at 31.19%. Factor in the dividends, total return, 35.07%. On their 1-year return on investment, that comes in at 58.59%. Adding in the dividends, total return, 59.83%. Their 3-year annualized, 10.54%. Magellan is a key supplier to major aerospace players like Boeing and Airbus, as well as several military programs. With increased global defense spending and, that recovering commercial aviation demand, Magellan, they certainly have some long-term tailwinds for sure. Industrials is not always the highlight of the Canadian market, but they know how to get the job done. And in a possible recession, that does hold a lot of weight for sure. If you are interested in any of the stocks we looked at today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey. Check out this video on Timber Creek Financial, and I'll see you in the next video.